Now that you have a better idea of how to actually get into the market and get out of the market, let's talk a little bit about indicators. Indicators help you make sense of price movement, but too many indicators can often confuse you. So I want to go over the main ones that I use and the ones that I think can help you, especially for the way that I trade and my strategy that I've used. The goal with these indicators isn't to predict the market, but it's to understand it, and hopefully you can use these indicators to help do that. What do indicators do in the first place? They're visual tools that help you analyze price, volume, and momentum. These indicators are going to help you confirm trends, reversals, and entries. The different types of indicators that I use are the simple moving average, or the SMA, the exponential moving average, or the EMA. I also like to use the RSI, the MACD, and then the VIX, the volatility index. In the beginning, I would say keep it simple. Start with around 2 to 3 indicators until you get a hang of those, then start to add indicators as you go along. In the beginning, you want a clear chart so that you can actually see price action and you can start to learn from there. You don't want too many indicators kind of fogging your mentality when you're trading. Eventually, you will probably get to a point where you actually don't need any of these indicators because you'll just be able to see price action. A lot of day traders like to use fair value gaps, inverse fair value gaps, breaker blocks, break of structure. So there's tons of different strategies that I can get into. That's not what this course is for. This course is just to teach you how I'm able to swing trade options and make money doing that. So I'm going to focus on that strategy and the indicators I use specifically for that. Indicators aren't magic, but they're just tools that can support your thinking and your decision making. Let's start simple and talk about the moving averages. Now let's get into the SMA and exactly what it does, how you can put it on your chart, and what it can show you, especially when you're looking at different price actions. So let me pull up my chart on SPY here. And as you can see, I have my indicators. So I have my MACD down here. I don't have my RSI. But what you can see is if I go up here and I go to strategies and studies, if I type in simple moving average, it comes up right here. Okay. All you're going to do is press add selected and move it over here. And I have it right here. And my settings for it are, I have it the length at 9, displace at 0, price to close. And all this means is you can actually see it right here. It's represented by this line right here, the one closest to the price action in the charts. But all the SMA is it takes the average price over a set number of periods. For example, a 50-day SMA adds the last 50 closes and divides it by 50. So for this one, I have it on 9. So it's just the 9-day EMA adds the last 9 closes and divides it by 9. So why does this even matter? It smooths out price noise and it shows the trend direction. So if price is above the SMA, it tends to be bullish, and then if it's below it, it tends to be bearish. Not only that, but you can also use this for crossovers with the EMA. So this is my EMA line. I'll get into what that is later. But you can see that when price or the SMA comes down and touches or crosses back above the EMA, it happens sometimes, then it's often a signal that there's a strong shift in trend and it's trading above it. So price is likely going to go to the upside. So as you can see here, SPY went up 3% in the matter of 8 days. Over here, it did it as well. It went up 1%, but it went up 2% in 6 days. You can see that if it's trading below, it's typically bearish, and then if it's trading above, it's typically bullish. It means there might be a run. Overall, the SMA helps you see trend direction, and if price is trading above it, that typically indicates bullishness, and then if it's trading below, it typically indicates bearishness. Next, we'll look at the EMA and exactly how you can use the EMA in congruence with the SMA to indicate when you should buy and when you should probably take profits. The next indicator is the EMA, which stands for exponential moving average, and this is basically the cousin to the SMA. And it just reacts a little bit quicker, but I like to use it on the longer time frame. So I have mine on the 180-day EMA is the one that I like to use, and I'll show you exactly why right now. So if we load into my chart, you can see that right here, if you go up to studies, strategies, kind of like we did before, you can type in exponential, moving average exponential, and it'll pop up. And then in my settings, I have close, 180, and then 0 and no. Okay, so this line will pop up. You can change it to whatever color you want, but this is SPY from April all the way until October. And as you can tell, there's a pretty consistent pattern. The EMA is going up the entire time, and this indicates that this is a bullish pattern. So from here to, let me see, from here, from here all the way up to here, SPY went up 20% in the matter of a couple months. But what you want to do is you want to be able to capitalize on these moves right here. So price came down to the EMA, shot back up, you can take profits, came back down, shot back up, you can take profits, came down, shot up. But as you can tell, the price comes back and it's almost like a magnet. It comes back here, but then it pushes off of it and it pushes up. Then it comes back down, pushes off and it pushes up, comes back down, pushes up, comes back down, pushes up, and then comes back down. And then you can see it even pushes up here. So this is really good, especially for my strategy in swing trading, because I could see this and I could be like, oh, this is a good discount because it had just dropped a couple percent. And then now it's probably a good time to buy because it's coming to the EMA and it's a better price point. So then I want to get into some option contracts here and I want to ride them up to here, or whenever I think that price is slowing down, because this right here is a 8%. This is a 8% move in 37 days. 8% move in 37 days, 40 days. And on options, that's probably closer to a 30 to 40% move, depending on which contracts you get, which could be insane. It could grow your portfolio pretty exponentially over time. EMA is extremely important if you want to take advantage of getting price at a good discount and being able to ride the different waves back up. So overall, combining the SMA and the EMA can show you the different trends and patterns of where price is and where you can see that price wants to go. You can also use it to see if price is at a good discount point, or if it's too overbought, or if it's oversold. And this can help you with your entries and exits when you're looking to get into options contracts. The next indicator we're going to talk about is the RSI, and it stands for Relative Strength Index. And the RSI basically just tells you when a stock is either overbought or oversold, essentially just when traders are overreacting. So how do you read the RSI and how is it exactly measured? So the RSI ranges from 0 to 100, with 0 to 30 being oversold and 70 to 100 being overbought. So I'll load up the charts and kind of show you what this looks like in the chart here. And as you can see, I have SPY pulled up on a 4-hour time frame over 180 days. And this is the RSI down here. You can get this by going to indicators, searching up RSI, and then just adding it over here. I usually do 14, 70, 30. These are my settings for it. So length is 14, overbought 70, oversold 30. Okay, so that's those are my settings for my RSI. And essentially this just shows you where a stock is oversold, such as right here, and then overbought, such as right here. And you don't necessarily want to use the RSI by itself, but it can help you tell when there's good price points to buy at. So let's just look at the oversold times right here. So you can see 30 over here is oversold and then 70 is overbought. So down here, it hits below 30. So you can see that this is probably a good point for you to buy because it's a little bit oversold. And as you can see, there was a run up after that happened. Up here, it says it's overbought. So typically SPY is going to continue upward on an upward pattern, but up here it's a little bit overbought. So if you want to start taking profit up here, it's probably a good idea because you've just profited from here all the way up until here. So this is probably a good place for you to scale down, maybe take some profit. Or if you're planning on holding longer term, then you can continue holding your position, but be wary because there might be a pullback soon because it is overbought. Down here, you can see that it's oversold again. So price came back down. Right here might be a good time for you to buy. and then you buy down here, and then it is oversold over here. So it goes from here all the way back up to here where it's overbought. And then if you come over here, it's oversold again. So you can see that there was a pullback back to the moving average, and you can see that it's oversold. So this might be a good time for you to buy, and then you wait until it's oversold again. So you're just making these moves when it comes back to oversold and when it goes up to overbought. You don't want to use this by itself, but if it's used with other indicators, it can show you exactly where might be a good time for you to buy and where might be a good time for you to either take profits or sell your position entirely. Overall, the RSI is just going to help you spot exhaustion in moves, and you might be able to get reversals using the RSI if it's either overbought or oversold. So this is one of the most important indicators that I use when I'm trading these long-term options. Now let's move into the MACD indicator so I can show you exactly how I use it to find my entries and also find my exit points. The next indicator I'm going to talk about is the MACD, and it stands for Moving Average Convergence Divergence, and this essentially just shows you where the momentum is in the chart, so it can help you estimate exactly where your swing highs are going to be and if there's momentum behind the move, and then when you're about to go over and have a downtrend, where the momentum is there before the move actually happens. Let's take a look at the chart so I can go ahead and show you exactly how I have my settings for my MACD and exactly what the different lines mean. So if I come into my chart here, you can see that for studies, I have my MACD in the lower area, and my settings for my MACD are 12, 26, and 9, and then I have it for exponential. And the MACD will show up right here, and essentially all this is showing is the crossovers between the 12 and the 26 EMA. Using the MACD, you can get better entries, and then you can also get better exit points. And I like to use the MACD to look at the different crossovers. So I'm going to come into this point right here. Let me back out just a little bit. As you can see, they cross right here. Okay. So the blue line crosses above this yellow line right here. And you can see that indicates that there's about to be momentum and that there's a push upwards. So this would indicate a buy signal for me if I was using this, and if everything else looked good, if it came down and it hit this, and I feel like both of these work together and this is a good entry, I would take my entry here, and then I would wait for the next crossover, which would be up here, and then that's where I would exit the position. So I would enter down here after it crosses, and then I would hold, and then I would exit my position up here after the lines cross over. And this gives you a pretty good idea of how you can use the MACD to get better entries. So for instance, right here, it does the same thing. When it crosses, you can see that price starts to push up, and then when it crosses back over, it starts slowing down. There's less movement, and this is probably a good time for you to take profits. So you're just making the difference between here and here. And with options, this is a big difference because as you can tell with traditional, if you're just trading it traditionally, that would be about a 1.7% move over 7 days. But with options, that could be a 5 to 10% move just in 7 days. And that's enough for you to, that'd be a great move because honestly, that's somebody's yearly percentage gain. And you can do this throughout the throughout the year. And that's only a period of 7 days. So imagine if you were able to compound this over time. Essentially just the MACD, when the lines cross, you can see that that's probably a good entry. And then when they cross back over, the blue line goes under the yellow line. That's time for you to take profits and exit. When the histogram, you can see that the histogram here, this green and this red, when it expands, that just shows that momentum is increasing. So you only want to use the MACD when you're looking at higher time frames because this is just used to confirm your overall trends. This works really well if you're swing trading or you're doing long-term trading. I wouldn't recommend using this for day trading at all. For the strategy that I use with options, I'm entering a trade and I'm usually not exiting that trade for 3 to 6 months. So this is perfect for me to get an entry low, and then I can sell once I think that momentum is slowing down. I would definitely avoid using this in choppy or sideways markets. MACD can help you confirm trend strength and also catch the energy behind a move, so that's why it's so great, but it cannot help you predict direction. So you definitely want to use these all in conjunction with one another so that you can take the best trade possible. Now let's dive into level 2, what it is and how it can be used to help you with your options trading. The next indicator I'm going to get into is the level 2. This one isn't used as much for swing trading, but rather for day trading, but I still think it's important to mention because it gives you insight into buyer and seller activity in the chart. So let's get in and let me show you exactly what this looks like and how you can use it to see buyer and seller activity. So in my chart, I have a day chart for SPY, and this is the 1 minute chart. And as you can see, I have my level 2 down here. You can find it right here. But essentially all this is doing is it's just displaying the active buy and sell orders in real time. So the bid and the ask orders in real time. You can see how many contracts or shares are sitting at each price, and the prices are given here and the amount of shares are given here. This just essentially helps you gauge momentum and liquidity, because when bids stack up, that just means that buyers are stepping in. And then when the ask stacks, sellers are dominating. And you can see where those are meeting, because right now the bid is at 685.60 and then the ask is at 685.56. So you can just see that it changes pretty rapidly. You can also filter this out so that you can see that you can customize this to where you only see orders over a certain amount. So say I wanted to change it to 1,000 and I would only see orders over 1,000, and then I would see the same thing on this side. But essentially, level 2 just gives you insight into the price action and what buyers and sellers are doing. The next indicator, and probably one of my favorite indicators that I'm going to get into, is the VIX. So I'll talk about that in the next video. The next indicator that I use is called the VIX, and this is also called the fear index, and it's probably one of my favorite indicators to use, especially during times of high fear. It's unfortunate, but usually that's the best time to enter the market is after a crash has happened, a recession is going on. COVID is a very good prime example of this. The VIX was at like insane levels, so it was a great time to buy, and I'll actually pull it up on the chart here. I'm just showing you this to show that these are the points that I like buying, is after the market has taken a huge correction and the VIX is at the highest. I'll go ahead and show you what this looks like on the chart. If you can see here, the VIX is VIX. That's the ticker for it. This isn't anything that I think you would ever trade. This is just to show you exactly when there's extreme periods of fear. Big spikes like this mean that there's uncertainty in the market and there's just a lot of fear, and you can see that this is another spike right here, and then there's smaller spikes here. Let me go back and see if I can find COVID. So this is a 1 day chart, but I'll go back to 5 years and I'll do 1 day. So let's see if I can find COVID. I might have to go back even more. I'll go back 10 years. Okay. So you can see this right here is COVID. The VIX just absolutely shot up and reached highs of 85. And this is just during COVID. And these were elevated levels of fear because everybody thought there was, there was an epidemic going on. So many people with so much uncertainty, the stock market is going to correct as a result. So let's go ahead and take a look at what SPY looked like during that time. As you can see, I'll have to go back. I'll do 10 years. So I'll go back to COVID. As you can tell, there was a huge discount on the S&P 500. It had literally gone down. Let's see what this is. From its highs, it had gone down 30%. Okay, so you're getting a 30, like imagine going to your favorite store and seeing everything as 30% off. That's the best way to explain it. is now you get the S&P 500 at 30% off. In fact, it even reached like 35%. That just goes to show you that when there's high levels of fear, the VIX is going to be extremely elevated. So if you look at the VIX chart, it's extremely elevated during COVID. And this is a prime area for you to start allocating and buying into leaps options, which I'll go into more later, how to look for leaps, what types of leaps to buy. But this is where you make your millions. People were buying options when the VIX was up here and the S&P 500 was extremely low, and people were going in with $10,000 and they were coming out with 100 to $500,000. Like, these are life-changing trades where you only have to catch one of them and it can literally change the trajectory of your life forever. And that's why I think this is extremely important, and this is a extremely important indicator, because this is where you can, multiply your account tenfold. The VIX essentially just shows fear in the market. It's based on S&P 500 options, and it's just the volatility over the past 30 days. The VIX, volatility, fear, index, whatever you want to call it. So usually if it's below 15, so we'll go to current time. Right now it's at 14.95. So that usually represents a calm market. This is near all-time highs. So we're at all-time highs right now, or pretty close. So that's why the VIX is relatively low. But when you see the VIX go above 30, right here, this line, this is where I usually like to start allocating into leaps options, because I see it as a good opportunity. There's a lot of fear in the market. There's a lot of uncertainty, and that usually leads to pullback. So when the VIX is highest, that just means that there's usually a pullback in the S&P 500. And this is a good area for you to start allocating or getting into the market, because there's more fear and there's more panic. Overall, this just helps gauge the sentiment of the market, especially during periods like this peak up here, it got to 65. Like, people, let's show this on the SPY chart. Like, I cannot stress, that's this peak right here. So this was a pullback of about 20%. And this was like Liberation Day. So when Trump had those tariffs and he was like 100% tariffs on everybody, people started panicking, they started panic selling, and this is exactly what that is. And as a trader, you have to take advantage of these moments when everybody else is scared, because look at this upside. That's 40% upside if you were to just buy the S&P 500. Like, you take $10,000, now you've made 4,000 and your account's at 14,000. If you bought shares, if you buy options, this could be 200, 300, 400%. That could take your account from 10,000 to 50,000 to 100,000, depending on what option and expiration you get. That's why the VIX is probably one of my favorite indicators, because it can literally tell you where everybody is scared, and those are the best times to buy, is when everybody's freaking out, they're panic selling. Like, think about where most of the millionaires and billionaires start investing. They start investing when everybody's scared. And I think that's why I use the VIX. I like to see where everybody's scared. I like to see when there's good buying opportunities. I don't want to buy up here at all-time highs. I want there to be a pullback so I can buy in, I can ride the wave, and I can make generational wealth that way. And that's exactly how I've been able to make over 6 figures this year just trading options, because I was able to capitalize on this. And there's so many different opportunities for you to be able to do this. Like, look at all the pullbacks that you see. Pullback here of 10%. Okay. This wave right here was 26%. In options, that's over 100% return. Like, it sounds insane, but these are crazy returns that you can get with options, and I'll show you exactly where you can find these returns. But you just have to be patient and look for the right time. When I say I do not look at charts sometimes, like, I wait for there to be a pullback. I take my position. If it goes to zero, I will write it to zero. But I know that, like, the chances of it happening, because I'm buying long expirations, I'm holding for the long term for the most part on these options. and just the returns that you can, like, they're insane. They're insane. So I think the VIX is extremely important for you to find these oversold levels. Like, you can even see it on, we talked about the MACD and RSI. On the RSI, look at how oversold this is. This is a great buying opportunity. Anywhere down here, you buy any options down here and you hold them up, you're going to make so much money doing that. And you do not even have to look at the chart. You just buy down here and you wait. That's 200 days, 275 days. That's literally like 3/4 of the year. Being able to be patient, wait for those buy opportunities, and then capitalize on them can be extremely huge for your portfolio, because it can just catapult you into financial freedom, essentially. Overall, the VIX is just your volatility compass. It lets you know exactly where fear is and helps you understand the market better than most other people would, so you can capitalize on other people's fear and enter the market when there's a deep discount.